It's RBA interest rate decision time again. Will they pause rates for the second consecutive month, or will they increase interest rates and deliver a hammer blow to Australian mortgage borrowers across the country? It's a big call for the RBA. Go too hard, they risk putting Australia into a recession that we don't need to have and cause higher unemployment as a result. Go too soft and pause too early, what the RBA may do is cause inflation to spike back up and higher unemployment in the long term and higher interest rates to get inflation back down the line. It's a big call. In this episode of Australian Property Talk, the first YouTube episode, we're going to be going through how they will make their decision. We're going to go through inflation, unemployment, economic growth, and financial stability. These are all the things that the RBA is going to look at when they're making their decision. The best part about doing an exercise like this and following me on my journey through this experience is you're going to get a snapshot as to how the Australian economy is actually performing now. It can help inform your property investing decisions by getting a better understanding about the macro setting that we currently operate in the short run and over the 12 to 24 months ahead. Hi, I'm Reedham Sayed. For those of you who don't know me or who don't follow our podcast, I am a 5 times top 100 mortgage broker, founder of Confidence Finance, and ex-Treasury economist, where I used to produce macro briefings on economic matters like this and quite familiar with how economics works. A long time ago, my story began by being a uni graduate, doing economics there, absolutely loved it, got a job at Treasury, and then I began Confidence Finance. I got that investing bug that many of you watching have. Absolutely love what I do. Property is my passion, my purpose, my drive. It all began, my own personal story actually starts with it beginning when I was 15 years old. Both my parents lost their jobs. We lost our family home and car as a result shortly after. And I felt really, really powerless at the time. And I made it my mission to never feel like that again. Became really, really educated about things, and I use property investing to secure my financial future. You'll hear a lot about this, my story, my experiences through this episode and every other episode going forward. But you also hear me talk about economics a lot because I love it, it's what I do, it's how I think. Let's get straight into it. We have inflation here in Australia and the rest of the world. Now, inflation is a money problem. It really comes from having too much money chasing too few goods and services. So why do we have inflation? Well, it all dates back to COVID and the policy measures that governments implemented at the time. Look, we're all freaked out. We didn't know what was going to happen. So what the government did in a time like this is, throw money at the problem, and effectively, the problem wasn't as large as the money that we threw at it. That's a hindsight call. We're operating with high degrees of uncertainty at the time, so no one really knew how much money to throw at the problem, so they threw a lot. Central banks all around the world cut interest rates, went through quantitative easing programs where they printed lots of money and flooded the system with liquidity and money to get through the COVID crisis. The back end of that is we printed all this money and threw lots of money at it, but we didn't increase the amount of products and services available in the marketplace. That meant we have too much money chasing too few goods and services, and that leads to inflation. You see that in Australia, where inflation rates currently and at a peak rate hit 8%, basically double the highest rate that we ever achieved before then over the last 40 years. Somewhere around that, way, way, way above the RBA span and way, way above where we've been historically. You can see that in this chart here. Inflation's just been running hot over the course of the last year, and it's not only an Australia problem. We've got this problem all around the world. Inflation rates in and around the developed world is near double digits, in some countries eclipsing 10%, and largely on the way back down as well, but way too high everywhere you look. So what central banks did as a result, pretty standard policy measure, is you threw money at the problem to begin with when there was not enough economic activity. Now we have inflation, so what you give, you take away. You've done that by increasing interest rates. In Australia, we've had the fastest tightening cycle on record. If you look at this chart, we've had big rate cutting cycles, but we've never had a rate rising cycle this large, this quickly, and this impactful, given the size of household debt we have in Australia at the moment. The context behind this decision is the last 12 to 18 months as well. In Australia, we've been raising rates so much, so aggressively, we haven't actually given it much time to see how these rate rises are playing out and how the Australian economy is actually responding. If you think of the Australian economy like a car, interest rate settings between 2 to 3% keep the car actually just moving along at the right speed. If you're in an 80 kilometer zone, you're going at 80. If you have interest rates below that, then the car, the economic engine, is likely going too slow. So you're hitting the accelerator. And that's what we were doing during COVID and over the last few years where we haven't had inflation and the Australian economy hasn't been growing fast enough. We've actually had below neutral interest rates to try and spur demand and get more activity, and as a result, get inflation up. Japan has this problem. In Australia, we have had below neutral interest rates for a little while. Obviously, with employment levels so strong in Australia and inflation becoming a problem, back in this chart, what we did was we increased interest rates. Now, when you have inflation this high and you have full employment, it's pretty obvious you need to have higher than neutral interest rates. You can't just have the car running at its normal speed. You need to be hitting the brakes because you're going too fast. So that's the situation we're in at the moment, and the RBA have already delivered that. We're at interest rates above 4%. In everyone's definition, we are at contractionary monetary policy. That is, we are hitting the brakes on the Australian economy and hitting it to slow the economy down. It's just, are we hitting it hard enough, and how quickly do we hit the brakes? That's the question that we're discussing at the moment, and that's the context behind this decision. It makes this call much more borderline, and every call going forward, much more borderline between a rate rise and a rate pause than the decisions made in the past, because it was fairly obvious we needed to increase interest rates past our neutral setting. And when you're coming from zero, the first 300 basis points, pretty obvious, clearly you got to do that. But from there, the last 100 basis points have been a little bit, yes, do we do it? Do we not do it? And now we're at a level where interest rates are above 4. It's very contractionary, so it's slowing the economy down quickly. We're not quite sure. The RBA is sitting there, each decision, mulling over all the data and deciding, hey, should we raise again or should we pause and collect more data? That's what we're going to be going through. So let's get started and go through the 4 reasons why the RBA must increase interest rates at its next decision. Number 1, inflation is still too high. It's a scourge on the Australian economy. It damages a business's ability to plan and invest. It creates inequality because those who have the lowest incomes are spending all of their incomes and the cost of goods and services is going up. It really damages society by eroding Australia's living standards. You're seeing that here right now. This chart is a magical way to show it. It shows what a $50,000 income earner feels every year. Now, you'd hope in a developed society like Australia that living standards improve and real incomes improve as a result. And you saw that between 2009 to 2020, just before COVID, real incomes grew by a little bit, not all that much, pretty slow growth, but hit nearly $54,000 at one particular point in time, around 2020. That's some solid growth. Not solid, that's some slow, but some growth in real incomes over time. But since inflation's hit our shores, what we've seen is that all be eroded away. And now in 2023, in June 2023 actually, we're behind 2009 income levels. And this impacts everyone. All Australians are hit by inflation, not just mortgage holders. So everyone's money the value of everyone's money is being eroded by inflation, and it's reducing living standards across the board. For us, it's easy to think in nominal terms. That's probably the way our brains work. Be like, I get paid $72,000 now, that's my wage. But if you correspond it back down into a previous time, be like, what does that wage actually buy you? It's equivalent to a $50,000 wage in 2009, and a $50,000 wage in 2009 in today's terms, it buys you less than it did back in 2009. So we're having a fall in real living standards as a result. What we've done in 3 years of real wages falling, it's going to take a decade to make up for. This is why beating inflation quickly should be a national priority. Getting inflation down must be the central bank's number 1 aim, and so far they've indicated that they're willing to wait until 2025. That is too much patience because it's hurting Australians across the board. Mortgage rates going up do hurt, some groups of people, a lot of groups of people, and does slow the economy down, does potentially cause a recession. But we're in a situation anyway where the curse is a giant problem in itself, and we may need to cop the medicine that we have to take to fix it. Here's another chart that shows it. In recent times, these red bars that show real wages falling in recent times, these red bars cumulatively, adding all these up, is more than the decade gains that we've seen altogether. So big problem. Inflation is damaging. The second reason why they can increase interest rates further is the jobs market is performing so well. This gives the RBA scope to increase interest rates because we're at full employment and even beyond full employment, and the employment market is not deteriorating as fast as they think or hasn't really deteriorated at all. In fact, we've added over 400,000 jobs in the last year alone since we began increasing interest rates. You can see that here, the yearly change, 422,000 new jobs created. Unemployment at 3.5%, near 50-year records here. Only a couple months ago, where it was 3.4%, is the only report card that's been better. Got a strong participation rate, a low underemployment rate. Overall, no matter which way you spin it, the Australian jobs market is in a complete boom. It hasn't been this good pretty much in anyone's life that's alive, other than elderly Australians, and I'm not sure they remember it. It's as good as it gets. This gives the RBA a great starting point to push rates up further. They can take out insurance policies and bring inflation back down quicker because the jobs market's starting point is so good. Now, unemployment will have to rise. That's clear. But when it's starting from this base, they've probably got a little bit more scope to dial it up a little bit hotter than it needs to be otherwise, because this is your starting jobs position. The third reason why they should be raising interest rates as well is house prices. House prices have been rising so quickly over the last quarter, it's putting pressure on the RBA now. This is because when house prices rise, people feel wealthier, and when they feel wealthier, they're more likely to increase their spending. In Sydney alone, house prices have risen by over $70,000 in the last quarter. Nationally, it's around $25,000, nearly $30,000, and it's still rising. In the month of July that's just passed, we posted another percentage point increase in house prices. When you add this up, you're putting inflationary pressures in the economy, and you're losing one of the key transmission mechanisms of higher interest rates. Higher interest rates are supposed to lead to falling house prices, and as a result, people spend less because they feel less wealthy. The opposite is happening, and that may mean that the RBA need to slow down the housing market, and they can do this by dialing up rates even further. A fourth reason that they should increase interest rates is actually the global context. Interest rates around the world are higher in key developed countries, are higher than they are in Australia. In the US, they've dialed up interest rates again this month to 5.25 to 5.5% target. Euro area interest rates are rising. Japan, forget about them in that chart. New Zealand, nearly 6%. UK interest rates higher. We've got interest rates rising across the world, and Australia doesn't want to be an outlier here. That's because it'll put pressure on our currency. Now, when our interest rates are lower than the rest of the world, what people will do is simply move their cash to other countries where they earn a higher return on cash. That's what interest rates are, a return on cash. And, you can just park your money in America and you'll be getting, 5.5% versus in Australia, you get 4.1. In doing so, that means money's flooding out of our currency, and that depreciates our currency further, making it more expensive to buy our imports, causing further imported inflation. So Australia doesn't want to be an outlier, and other central banks increasing the interest rates actually puts pressure on Australia to match the pace. You see this a little bit here with CPI figures across the world. You see CPI rising a lot, and interest rates have risen a lot as a result. Now, on the downward cycle, these countries are experiencing falling inflation rates, but they've pushed interest rates higher than us. So there's some evidence here coming out. It's all new data now, but there's some evidence coming out suggesting that, inflation's coming down around the world, but they've increased interest rates. So if Australia keep doing the same, then the international experience is our inflation will come down too. Do we need to increase interest rates to achieve this or not is the question. So there you have it. They're the four main reasons why the RBA should increase interest rates again shortly. But it's not all a clear and rosy picture. Well, not so rosy in this circumstance. There's a lot to discuss, and there's a lot of counter forces here. We're going to go through those and provide 5 reasons why a pause is actually the right thing to do. Now, the RBA is going to be circulating all of this information that we just presented, balancing the need to get inflation back down as quickly as possible with the rest of the information that we're going to provide. Are you enjoying this video? Are you learning something? Do you have a comment to share? What do you think about these reasons for rate rises? Is there something I've missed? Drop me a comment below and I'll answer them and provide my thoughts on it. If you can and you're enjoying the content, hit that subscribe button, follow me, and I look forward to providing more and more awesome content. Do as much as I can to help inform and educate. Let's get into it. Here's the 5 reasons why a rate pause is actually the right thing to do. Let's get straight into it. Number 1 is the RBA's own forecasts. So they've come out in the latest statement of monetary policy available, May 2023, a couple months old now. They've provided checkpoints along the way for inflation, growth, and unemployment, and a whole range of indices, as you can see here. They've provided checkpoints for how the Australian economy progresses over the months ahead, over the next 2 to 3 years, all the way out to June 2025. So here, according to these checkpoints, we are beating that inflation trajectory on the way back down. Importantly, when they released this, and over the last couple of months, the RBA have been very clear in stating that they are willing to be more patient than other central banks to get inflation back down. This goes against that point that I just mentioned about the need to follow other central banks. The RBA explicitly have said that they will be more patient to get inflation back down, and they want inflation back down by that mid-2025 timeframe. It's a bit of an arbitrary timeframe that they picked, but that's when they want inflation back down and, have a gradual pathway back down. And most of that time is actually inflation a little bit above band, not at 8%, roughly 4% and on the way down. We are beating that trajectory already. For June 2023, we've just passed that checkpoint, so we can measure against it. Inflation, 6.3% is the benchmark there you have. The monthly data for June 2023 is at 5.4%. We're well below it, and it's falling quickly. Trimmed mean inflation, 6%. We're at 5.9%. GDP, 1.7%. Our quarterly GDP prints are slowing, maybe slowing a bit too quickly as well. The unemployment rate, they had 3.6%. We're at 3.5%, so the employment market's a little bit stronger than they expect. But more broadly speaking, their forecasts are pretty close to actually what's happened, but inflation is coming down quicker. So if you have the RBA coming out saying that they're willing to be more patient, providing their own forecasts and giving us checkpoints along the way and saying that, hey, look, if we meet these checkpoints, this is the pathway we'll take, and we're beating that, then why actually raise interest rates? Why don't you just sit and pause and actually let your work play out, collect data and see how it's all going and continue to meet these check marks? And if you fall away from these check marks on the wrong side, then you act. But we're not falling on the wrong side. In fact, we're on the right side of it. So it makes sense to pause when you look at their own forecasts. Bear in mind that these forecasts as well include a 3.75% assumed cash rate. We're well past that, so they've already thrown in a couple insurance interest rate rises. The last 2 rate rises have been the insurance policies, I guess, for a lack of a better word, to drive home these results. They've pushed it above the assumptions that they used. So, these are just forecasts, so a new set of forecasts will be provided after the rate decision. I think on Friday this week it will come out, and you will likely see a downward revision on inflation, a downward revision on GDP, and unemployment sort of forecasts remaining by and large the same. Given that's what they're going to provide and that's what's going to come out, it doesn't really make sense to raise interest rates and then come out a couple of days later with downward revisions of inflation and growth. Another big reason, this is the second big reason and probably the winner of the argument, the quarter-on-quarter inflation data that got released. Quarter 2 inflation data got released last week, and it's the biggest data set that's come out for this month, probably for this year actually. It shows that inflation is coming back down. In fact, according to the RBA's preferred measure, trimmed mean, the rate of inflation has halved. We're at a 1.8% print 4 quarters ago, when we were at the height of the inflation problem in September 2022, where we had those 4 back-to-back, maybe 5 or 4 back-to-back 50 basis point increases. Inflation was just running at nearly 2% a quarter, and now it's back below 1% a quarter. So the rate of inflation is coming back down quickly, and floating back to a different chart, you have the international experience to look at here as well. So a lot of these countries, Australia here, got they're a little bit behind on inflation coming to Australia. This is because of the lockdowns in June, July, August, September 2021. Australia went through a lockdown, a little bit delayed with that lockdown versus the rest of the world. So inflation hit our shores about 6 months later. And reached a peak level that's a little bit lower than other countries as well. But if you look around, all other countries' CPIs are coming down fairly quickly as well. So that gives merit to a pause. Canada is a really good one to look at, where their CPI has fallen from 8% to 4.3% in this March 2023 data. But by June 2023, they're at 2.8% now. So inflation is falling around the world. That means we're going to be importing less inflation too, because we operate in a global economy. If the price of goods and services in Canada and the rest of the world is coming down and the cost to produce them coming down, then those will be passed on and flowed through to Australia as well. So that's another reason for pausing. That's the main reason for a pause. Inflation levels are coming down. We've got a little bit of time to be patient. We don't need to fire another bullet because inflation is coming back down quicker than the RBA expect. And the trajectory of inflation down looks positive too when you take into account the international experience. Factoring all of that information in, they may not need to throw in more insurance and throw in more cover for the inflation problem and just let time do its thing. Looks like by the end of the year, at this rate, if we have another quarter-on-quarter print that shows a downward trajectory at say 0.6%, we're going to be in band on at least at a quarter-on-quarter level this year. So we don't need to raise rates further now. Now, the more I actually explain this, I'm kind of convincing myself here that inflation levels are falling. It's pretty obvious, pretty clear. It's in the data. It's in the international experience. You don't need to raise rates even further because you've already jacked them up past neutral. You are hitting the brakes pretty hard. You don't need to slam them. And another rate rise or two may be that slam. So the inflation story is telling us that we probably don't need to actually increase rates. Another piece of the picture is economic growth. So this is really important because the RBA have made clear what the narrow path that they talk about means. They've specifically said that they want positive economic growth in Australia. Now, if you look at the quarter-on-quarter data here, straight from the ABS, you've got our growth figures. So GDP, roughly 0.6, 0.8%, over 2022 for 4 quarters in a row. That gives you a growth rate between 2 to 3%, pretty much the standard Australian growth rate. Now we have the first quarter of 2023 at 0.2%. That's a growth rate annualized at less than 1%, and it's dangerously close to zero. So we may be producing less and less in terms of growth, and that could cause a problem down the line for employment. So unemployment figures aren't showing it at the moment, but if we're producing if we're not growing our production, what we're growing, then unemployment will rise in the future because businesses will simply react to them not making any more money and not making any more products and effectively get rid of workers because they won't need them because they're not producing any more. There's an element of productivity over time, AI, tech, technologies that help productivity over time. So we need to be growing to effectively keep the same labor force. Otherwise, businesses adjust their decisions. On a per capita basis, the RBA haven't made this part clear about whether a narrow path means avoiding a per capita recession. So on a per capita basis, we are already moving backwards. Quarter one data had us moving backwards 0.2%. We obviously have a lot of population growth at the moment, and we're barely growing our production. So combine those two forces, and you have us moving backwards per person already. We may be in a per capita recession once the data comes out for this quarter that's just ended, for the June 30 quarter that's just ended. That's out in a month or two, and that will likely show that we are in a per capita recession. And scarily, it may show that GDP is actually moving backwards already in Australia. If that's the case, then we've probably already overcooked it and pushed interest rates too fast, too high. Another thing to look at, this is more timely data. This chart is a little bit messy, but what it's showing is retail sales volume. So this is the volume of sales occurring at shops all around the country. What you have is pretty much a nosedive, and we're officially in a retail sales volume recession. That is, on a volume level, we've had 2 quarters of negative growth. So if you think of it this way, go to your local Westfields. That Westfields is selling less stuff now than it did 6 months ago. Even though the population has sort of boomed in that time period, That's a very timely indicator of how the Australian household is responding to rate rises. If retail sales are falling so quickly and consumer confidence is really low as well, then that combination of factors kind of gives you a lead indicator that, hey, households are actually responding, and that means unemployment is going to come and slower economic growth is going to come because people are spending less money at stores all around the country. People spend less money, then eventually that business starts getting rid of their workers and unemployment goes up as a result. This I found interesting, particularly for property investors, because it showcases how sensitive the household is across different states. So this is retail sales by states. You'll see that interest-sensitive sectors, interest-sensitive states, those with bigger mortgages, New South Wales, Victoria, Queensland, have larger negative contributions to retail sales, while WA, Tasmania, Northern Territory have positive retail sales growth. Pretty interesting difference between states across the country. And the fifth reason, the final reason for pausing interest rates is looking at financial stability and the fixed rate expiry curve. So we actually have a lot of monetary tightening that hasn't actually occurred yet. So a lot of borrowers across the country haven't experienced rising interest rates yet, but they're about to, because we have a giant uplift in the roll-off of fixed rate loans to variable rate loans over the next 6 months. We're in the peak period at the moment. We had a step up in 2023 already, and now in the second half of 2023, we're going to have a huge rollover all of these loans. And by the end of 2023, most Australian borrowers will now be experiencing higher interest rates and eroding their savings as a result. And what we can see there is the RBA's monetary tightening hasn't actually taken effect on the entire market yet, but it's going to do so in every month ahead. Another reason for a rate pause. So overall, there's plenty of reasons here for both increasing interest rates and pausing interest rates. My take on all of this is, given the pace of inflation coming back down, I think that outweighs the dangers of inflation, and taking into account that they meet again in September, October, November, pausing is the right thing to do here and allow themselves a little bit more time to collect a little bit more data on how the Australian economy is playing out and hope that inflation just comes back down. Remember, the goal of the RBA isn't to have higher interest rates cause higher unemployment and cause a recession. Some people want that, but that's not their goal. Their goal is actually to maintain positive growth, get inflation back down on a steady pathway, and keep Australia's employment and economic engine going. To do that, if they raise interest rates again, I think the balance of risks to this rate decision actually aligns to a pause. Interestingly, I hadn't decided that until I went through this presentation and went through all of this. So it's really cool that going through that exercise, I came up with the result that a pause is probably the best thing to do. What do you think? Leave a comment below with what you think the rate decision will be tomorrow and what the right call is. If you enjoyed this video, do me a big favor, hit that subscribe button, hit that bell notification. I'd love to be producing more and more content for you. Hope to be doing at least one of these a week. And I look forward to seeing you again soon.